let's say we get a run up to 4,200 or so.
Yeah.
I mean, I know you're not the bull, you're not the bear, you're the eagle. You're just up there looking, is it overbought, is it oversold?
Yep.
Of course, if it gets to a point where it's oversold, you'll say start lightening up. But do you see this run as something that could sustain throughout the year in general, or like, is this the last hurrah, more like a last hurrah, like to sell out, at good prices before maybe there's another leg of the bear market?
Well, there's, look, so this weekend's newsletter that I'm writing right now, and we'll have it published tomorrow at realinvestmentadvice.com, is kind of talking about this very thing, right? On one side, you've got every really historical good recession indicator pointing to a recession, right? So the 6-month rate of change of leading economic indicators has a perfect track record for predicting recessions. That's in recession territory right now. Inverted yield curves, we've talked about. Our economic composite index, which has 100 different data points that covers everything from manufacturing to service to even international and leading economic indexes, that is also in recession territory. So, and that has a perfect track record also of predicting recessions going back to 1970. So, there's, all this data out there that says, hey, the economy is going to go into a recession. And yet, economists right now are raising their economic growth rates for the rest of this year. S&P, which, okay, take FactSet, throw it out the window. It's complete crap. Never use FactSet. S&P is the one that produces the earnings estimates, and they're gap-based for the S&P 500, right? So if you ever want to look at earnings, look at what S&P Global produces. That is actually suggesting that earnings are going to rise to the peak of January 2022 by the end of next year. So Q1 will be the trough in earnings, according to the S&P. And by the end of next year, earnings will be back to where they were at January of 2022. So that's a very optimistic outlook. And we talked about, we talked about last week, I think it was last week, that, look, if you're a buyer of gold, all you care about is real interest rates. Whatever direction real interest rates are going, that's what tells you to buy or sell gold. When it comes to the market, it's about earnings estimates. And right now, those earnings estimates are moving up, not down. So that's giving a tailwind here because investors are looking at the valuation of stocks going, yeah, they're expensive right here, but if earnings grow by the end of next year, that valuation is not so expensive. So investors are starting to buy stocks in anticipation of a recovery in earnings. And here's what's interesting, right? So since January, 88% of the rally this year has come from 10 stocks. I wrote about this back in October of 21, because at that point in October of 21, now remember this is before, this is the tail end of the whole.
Before the wheels came off, yeah.
Right. 80% of the rally was being driven by those same 10 stocks. And of course, we had 2022. Well, we're back to that. And what was interesting is November of last year, and you and I talked about this when we were doing the interview, I wrote that stock. I said that article called Are FANG Stocks Dead? Because everybody was saying technology's dead. Nobody's on FANG stocks anymore. It's, what we said then is don't count them dead yet. Everybody thought energy was dead in 2021. It was the best performer in 2022. Don't count FANG stocks out because everybody thinks they're dead and they're typically not. This year, FANG stocks, your best performer, energy is your worst performer. So, it's just this rotation in the markets that's going on, and investors are making bets on where they think the economy and earnings and the markets are going to be. And right now, that bet is no recession. I don't know how you get there, but that's what the bet is.
All right. Okay, a couple questions on that. One, you mentioned yield curves, inverted yield curves as a predictor of recession. You've always said you get a notice when the yield curve inverts, but then you got to watch when the yield curve uninverts, because that means the fuse is lit, right?
Right.
We've got some yield curves that are really uninverting right now, right? Okay.
Yeah, the 10-2 in particular is starting to uninvert. So again, it hasn't uninverted yet, but yeah, so the statement is always that the warning sign of a recession is the inversion of the yield curve. That just warns you that a recession is coming. The uninversion tells you it's arrived. And so we're starting to see the 10-year, 2-year uninvert, which tells us we're actually closer to the beginning of that recession than not. But again, everybody's saying that it's not going to occur. So
Okay. So this is the question I'm sort of working up to here. So I put out this on Twitter the other day, and it really was an honest question. The market is predicting the Fed is going to be cutting rates starting by mid-year. Right. I think right now it's projecting the Fed's going to start cutting from a federal funds high of around 5, which is projecting where it's going to be around May, down to about 4.2% by the end of the year. And the trajectory continues downward into 2024. Right. So Powell has, basically said, look, there's pivoting's not even on my roadmap right now. Right. I'm gonna hike and then pause and hold it there for a long time. We've talked for a long time about how, the thing that's going to force him to pivot is going to be some systemic rescue he's just going to be forced to do. So if the market is confident at this point from its predictions that something is going to be so bad it's going to force Powell to pivot by summer, why is it in rally mode right now? Because it is highly likely not to be for bullish reasons at the time.
Right. So if you check your Twitter, I responded to you. And I said my response is, how do you spell relief? The old Rolex commercial, right? How do you spell relief? Liquidity. So, and I gave you 3 charts. One is our liquidity measure, which is the Fed funds balance sheet less the TGA account less reverse repo. And there's been a huge spike in that liquidity measure, and the market tracks that liquidity. So, despite the fact that we have all this other stuff going out there, the Federal Reserve has already reversed back into providing liquidity through 2 measures. One is, of course, the expansion of the balance sheet. Now, that's not QE because those are loans to banks, but it is an expansion of the balance sheet. But number 2, and a much bigger issue, was the opening of the dollar swap lines that they did to help bail out Credit Suisse and UBS and the whole European banking issue. So those are always the first steps. Whenever the Fed has opened dollar swap lines, the next thing to come is more liquidity. So, this all goes back to the article that I wrote called Pavlov's Experiment, which discusses Pavlov's experiment with the dogs, where he would ring the bell and they would start to salivate in anticipation of getting fed. Well, for 12 years now, we've been teaching investors the ringing of the bell means to buy stocks. And when you open those dollar swap lines and expand the balance sheet, most investors don't understand where the balance sheet comes from. They don't understand quantitative easing. They just know if it goes up, you buy stocks. And that's the ringing of the bell. So we've rung the bell. And what the markets are now expecting is more liquidity. And that means stocks go up.